Welcome, ladies and gentlemen. Commodity TV here today out of our home office studio. And with me here is not in my studio. Actually, we are doing this via online. Professor Dr. Torsten Dennin, and he is the head of asset management of AMS in Zurich, Asset Management Switzerland. And we want to talk about the Corona crash and the flight in cash 2020. Torsten, good morning and welcome to Zug at your home base.
Good morning, Jochen. Thanks for inviting me over in this difficult times.
Yeah, thank you very much for taking the time, as we are long-term friends, and as we are hanging around a lot together and discussing a lot. This is, of course, a fantastic time. Now you're on the presentation modus, great, to really talk about the Corona crash. And today is a great day. It's Friday, and it's I think it's a triple witching day at the futures markets, and we are really up. I saw just already at the ATX in Austria is up 12% even, which is fantastic. ÖMV today, the biggest oil company of Austria, is 25% up. So there we see there's also opportunity in the markets, and I'm really looking forward now to discuss this with you. And Torsten, the word is on you. The floor is yours.
Okay, thank you, Jochen. Corona crash and the flight into cash. Actually, it's my third big financial crisis I'm in since I started my job in the early 2000s. What you see here, I have the German equity market as a proxy. Same thing as for Switzerland and for the S&P. I think from the resources side, everybody watches the TSX and the TS Venture. We've seen like multi-decade lows, all-time lows for some of the indices. On the German equity index, we lost 40% because here is a little bit more on the export side that is in the fire. We have some of the flight companies like Lufthansa as well. But 40%, that's an amazing crash. And what is more amazing is the high level of volatility. So the crash was fast and furious on that side. Yeah. It was faster and harder to get than the 2008 crisis.
That's right. And even today we are at 9,100 already again, and I think 8,200 was the low intraday this week. So that's 1,000 points volatility easily.
Easily, they're 6% up, 5% down, like a 10 to 15% price move on a main index. For years we haven't seen movements like that. And the question now is, after we've seen last week the central bank action from the US, then we have seen now the action taking place from the ECB, also the bond buying, the corporate bond buying, and the rescue umbrellas that we see in the market gaining bigger and bigger, because unfortunately we will need to bail out the whole real economy. 10 years ago, we just bailed out the banking industry, just to say just. But this becomes bigger and bigger. And this comes at a time when some other players like just put some cap on the commodity markets. I brought with me today also the price chart for crude. Crude is up in the electronic trading today, also 15%. So more or less going back to the 28-30-ish level, but this is still a nightmare compared to the prices we had a couple of years ago.
One question, what is KSA?
Kingdom of Saudi Arabia.
Okay, just to make sure everybody understands that. Okay, yeah, that's right.
Yeah, the sheikhs, the Saudi Arabian guys, were shocked really and spooked the market on their action, because everybody was expecting they are limiting their production because of the coronavirus and because of low demand. But no, in reality, it was a gray swan, I call it in between, because it's not totally unknown. But the consequences have been severe. We've lost about 35% in just 1.5 trading sessions in oil. 18 years in the industry, I haven't seen that before. And this is not only important, for the commodity markets, this is important for the credit markets and therefore for the bond markets and the equity markets. And you mentioned OMV, Austria, the European oil names, and nobody makes money sub $30. So if the price stays at this level, lots of the companies will fall into bankruptcy. The fracking industry in the US is like the first victim, and I think the potential we see here is that in the fracking side, we probably will lose up to 4 million barrels of oil production in the coming months if the prices stay like in this $30 range.
But is that really such a tragedy? Because I looked it a little bit up, and 10 years ago, we were like on a 92 million barrel per day market worldwide. And now we were at approximately 102. I think the peak was 103, 104 million barrels per day usage in the world. So if we go down by 4 million or 5 million, I mean, this is something even still higher than we had it before 2007, 2008, right?
Yeah, on this point, Jochen, you're definitely right. In terms of oil demand or consumption and production, 100 million barrels in the moment, if we will lose some because of a weak demand. I mean, lots of air travel is grounded, flights are not going, car travel is restricted, we stay in home office. So demand side is anyhow depressed. But
like
I think
zero.
the more it equals zero. But I think from an economic point of view, as I look at it from the exchange side, from the asset perspective, but also from the longer term economic perspective in my role of as a professor of economics, this is a kicker in the system. You can see when the fracking industry, all these like small and medium guys who are having like high levels of debt and high leverage, they're getting bank credits to fund like the fracking because it is very high capital intensive. And you need to know that like fracking is a very high degree and high yield in the US. So high yield, this can tickle into the high yield demand. This can tickle into the corporate bond side. This can push like the credit spreads and the spreads up. And then we have like the bond. I call it like my love child is the bond bubble. So this has the potential. The crude can trigger like a blowing up of a global bond bubble from the high yield and the credit side. And this becomes dangerous when we think this 40% in equity is just like a kindergarten.
Yeah, that's right. So then let's come to gold, which you are considering as an investment, I think.
Always. I think from an asset manager perspective, gold is always an investment. It's just a question about how much gold you should own. So definitely what we're proposing, like 20 to 30% gold holdings on the physical side in the last years, a bit unpopular when equities are rising from record high to record high. It was actually from last summer on quite a good allocation, but I think there's a case for the longer term perspective in gold, and this is something I sum you up in 3 charts. So basically 3 in 1. The first one is a justification of the long-term bull market that we see here. From the 2000s on, I mean, looking at the 1970s where gold, like an ounce cost like $35, regulated by the states, then we had the hyperinflation. This is something we're running into now when we need to fight this economic downturn with more debt. So we probably get also into more inflation because of European and American helicopter money we need to bail out. And then we have like this bull market we've seen since the 2000s. I mean, the S&P 500, like equities, have a nice run, but they're outpaced since the 2000s by the gold price. And more important, gold traded down like $150 from the top now, from 1670, 1680 to 1500. But this is in terms of percentage, not to compare with the S&P 500 that's lost 30%.
That's right, and I think this only happened because the people needed cash to really cover their margin calls, right? And their credits.
This is like the most important reason. Yeah, when you have like an asset that is still in the green and you want to buy either equities or you need to get some of your leverage out, what you can sell is a good performing side. So therefore the hedge worked quite well for most of the people. And my case is you need a high degree in gold, and some of the gold miners looking forward for the coming years.
Absolutely. So then let's have a look at the gold miners, because you are saying there's a lot of leverage, of course, and I see it the same way. Because if you have gold miners which have a good cost structure, if you take the large ones, I would say a Newman for sure, it's an interesting company. Agnico Eagle probably is great, yeah. And also if we go a little bit on the royalty side, Franco-Nevada, but also Osisko Gold Royalties, I think they're way too cheap. And if we look at the smaller ones, I could imagine like RNC, Fiore. Those are smaller companies, but they are getting a lot of leverage now when gold would start a real run here, and they are solidly financed and make cash flow, but also like a Caledonia Mining with quarterly dividends payments. We really like that, of course. And if we look at the good developers like Bluestone Resources, like Max Silver, companies like this, probably that is a great idea to have a look on that. What's your take on that?
Yeah, I think the exploration companies that are like in a development stage, or like close to production, into the production, or even the smaller producers that offer lots of value. I give you some food for thought here. Looking at like global blue chip companies in the moment, like let's stay in the European region, like nice car companies, BMW or like Mercedes, right? Looking at Daimler at 20 to 22 euros in the moment, and then look at some guys like Lufthansa and the daughter company like Swiss, grounding 80% of their flights. Their business in the moment is broken. They can't get up. There is not a single car being exported, even produced. VW said they are stopping production. So these companies,
the same 2 weeks.
So these companies sliding deep into the red here in the negative things. And then this is like, I think the first time in my 20 years of experience to say that, look at the solid business model of a gold miner in the moment. Just pause here for a moment, a solid business model. Because, I mean, we can argue about what is the production cost all in for like an ounce of gold for the industry.
1,000, I would say.
Yeah, I would say it's a bit lower, but let's assume like 1,000. This is very conservative and including some cost cuts. Because what I showed you with the oil price, this will ticker into the system. 60% drop in oil prices needs to say energy prices get cheaper. This means production costs of miners getting cheaper, like in the medium term.
Massively, especially with those with an open pit.
Exactly. When you see like the transport, the diesel, and all the other energy costs are related to oil. This is to come. But now let's assume what you said: $1,000 production costs. The price per ounce in the moment is 1,500. So you have like a huge positive cash margin of every ounce you're producing as a gold miner. And look at this chart in the moment, the gold miners got sold off with the equities in general. So you have a huge discount gold miners, not only to gold, but also to the market. So as you said, gold miners are super cheap. And when you now have to allocate like $10,000 to $20,000, are you buying like a Daimler or like a BMW or like a Bayer or like a Lufthansa, which business model in the short term is broken? Not yet, exactly. You look for like cheaper deals. Or if you want to have a value investment, you look in something with a 50% positive cash margin, with a cheap valuation, with book value below 1. Oh, look, and there's a gold miner.
Yeah, absolutely. How would you rate exploration? Because I had some very interesting phone calls the last days, of course, and there were several investors saying to me, "Well, exploration, I mean, it's dangerous." And I said, "Yeah, that's correct. But if you look at companies like Orania or Orange Resources, for example, they are fully financed. They have the cash in the bank, and they've stopped spending because they cannot drill anyhow. And I think this might be also a great idea to have a look at because when you are fully funded for the next 18 months, you should really survive, right?
Yeah, I think the magic sentence you just mentioned yourself. This is if you're fully funded, if you have the cash. In a crisis, cash is king, as it almost always. But if you have the cash, for exploration companies who need to raise cash in this environment where everybody is skilled, difficult is a positive term I would use on that, right? So therefore, exploration has the most interesting upside if you're fully financed project and an enormous swing. Look back at the 70s, the 1970s when you had a big run in the gold companies. We're not talking about like a doubling or tripling in the gold exploration companies. We are talking about the 10-folding and 20-folding. And this is something that can come if you have 50% positive margin and like a raising production. So therefore, exploration, interesting as a part investment, quality and cash is king, projects fully financed.
Yeah. Definitely. And I love the last sentence here on your reasons to own gold. I mean, that's all for sure against inflation, loss of buying power, but I love that you are writing a rise above $2,000 is likely in the coming years.
At the last Minds and Money in London, I quoted for investing news like 2,000 to 2,400 in the terms of the next 2 to 3 years. I'm still sticking to that because if you see this rising debt and the central bank actions, the low interest rates, the macro environment, of course, you need a certain allocation to gold, and investors like central banks are flocking to gold and pushing the price up. I mean, if your currency amount is rising by 30% and the gold price is not, then it needs to get more expensive, and that's the dream of it because it's a quite easy mechanism. It just needs some time.
Fantastic. Great. I think there's not more to add, honestly. Maybe the only thing that your new book is available on Amazon. It's a bestseller already. I have it at home, of course, signed from you. I love it. Yeah, it's fantastic. And even you have it in Russian now. That is great. And yeah, I really can recommend that book because it gives a great history of the bubbles, and it makes you maybe to understand the markets much, much better after reading. And yeah, Torsten, thank you very much. That was, as always, very comprehensive and is highly valued, the information. And thanks for putting those charts together. And I have a good feeling that we probably do this next week again with some new situations, maybe, or hopefully.
Yeah, it would be my pleasure. I'm working hard on it, maybe to add a new chapter, hopefully not too fast, like the explosion of the next bond bubble we've seen here to put into the book as a new chapter. Yeah. Anyhow, I think it would be lovely to talk next week, hopefully not at a lower level on global equity indices. I hope we see like some short-term stabilization here, but first to gain some value on the gold side.
Super. Torsten, thank you very much for your time. All the best to Zug and have a lovely weekend, at least at the balcony, because maybe we cannot get out, right?
No, pleasure. Same to you. As long as you have a good bottle of red wine, everything is fine.
Oh, thanks. Definitely. That is for sure. Thank you very much. Yeah, ladies and gentlemen, that was Professor Dr. Torsten Dennin from AMS Asset Management Switzerland. Yeah, and you heard it, tough times, a lot is going on, especially oil is really on the high volatility side and really crazy prices here. And gold is definitely one of the safe havens to really own and to make sure to ensure your private wealth. It is an endurance, it is physical health, it's really a good idea, but also to have a look at solid gold miners, at solid development companies, and of course at financed exploration companies. That is also very important and probably can make you in the future a lot of money. Maybe the time is not yet right. Maybe there will be another shakeout next week. We don't know it because we all sold our crystal balls last week, but we try to keep you informed. Thank you very much. Do your homework, but most important, stay healthy, have a good bottle of red wine, some gin tonic, that always helps, and wish you all the best, and thanks, and see you all soon. Bye-bye.